Thank you, Andrew. Some food for thought there in terms of potential winners and losers. What we're going to do now then is have a question and answer session. And so hopefully you've been given some thought to areas of particular interest you want to direct to members of the panel. I thought I'd start just with one question to you all, but perhaps Ian, you in particular. I was struck by some of your let's call it provocative thoughts in terms of the prospect of face-to-face financial advice. So if I go into one of your branches now and ask to see somebody, what happens?
The answer is, can you hear me? The answer is at the moment, if you go into one of our branches, we'll introduce you to our online proposition. And as I said during the presentation, that's predominantly online driven, although it is also supported by a telephone service. So there is also a number you can call that will help you navigate the site and help you understand what the options are available to you.
And Ed, you kind of showed some statistics to begin with about the kind of life of persistency of assets, and I was struck by the fact that obviously if you're dealing direct with the consumer, those assets tend to stay with you for a longer period of time. So, what role then for face-to-face advice, and what value, and what do you think advisors need to do to demonstrate real value, particularly when there's organisations like Barclays that are encouraging direct activity?
So we absolutely firmly believe there's a place for face-to-face financial advice, obviously in the post-RDR world. It's just going to be in different segments of the market. So I think the points that were made around the direction of travel of where advisors will go, they will likely go to the high net worth customers, and they will likely focus on those customers who have more complex financial planning needs. If anything, the actual demand for advice in the UK should increase. So the peak time in which an individual wants advice is at retirement. If you look at the wave of individuals who will approach retirement in the next 10 years, there will be significant demand for advice. The big question is going to be how's that advice delivered?
Andrew, what's your perspective?
Yes, so I think that links to one of the things I was saying with the workplace, because absolutely in terms of at retirement people need advice, as has been shown. That's when people can make mistakes. They just immediately invest in annuities provided by their pension provider. All analysis shows that there's often a 30% differential in terms of what they get when they vest with their existing provider versus if they go into the open market. So that advice, and that's the most natural place people would get that, is in the workplace, because they've got the corporate pension and they get it there. So that's one. And absolutely, I mean, I don't think we'd want to give any illusion that, you know, the need for advice goes down. It just has to be done differently. And as I was saying, in terms of the mass market, that really is, I think, the question, and something I don't think really has been addressed particularly by the regulator in terms of there's pretty much a, you know, we will build it and therefore people will have more confidence in terms of what type of advice is determined and the pricing of that, but just the economics, as I showed, just didn't work in that mass market.
And Ian, just one question for you. I mean, you talk about the importance of brand to attract customers, and can you just kind of expand a little bit on what aspects of brand you think are important? You talk, I mean, certainly, I think you mentioned awareness of brand and the relationship, but where does trust factor in any of that, do you think?
Obviously, trust is a key issue. You know, these are long-term products. People are investing for, you know, a minimum of 5 years, and therefore, you know, they've got to believe that those institutions that they've invested with are going to be around for that length of time. So I do think it is an important factor. When you look at the research, you know, there are those people who have a great relationship with an advisor, you know, and core to that is that they trust the advice they get. You know, unfortunately, the research also shows there's a good chunk of the market who've had encounters with advisors and didn't come away with the experience they expected. So, you know, it is the classic one. You know, trust is difficult to win and easy to lose. So I think for all those players in the market, trying to build that relationship, trying to build that trust will be critical in the future.
Okay.
I think just on that, I think it's very interesting, because whenever you know, surveys are done and people are asked, you know, where do they look for advice, not in a technical term, but sort of information, you know, as you know, sort of friends, relatives always comes up very highly. And with the growth of social media and the fact we've seen, particularly in the fashion world, you know, Twitter, etc., when a hot product, dress suit or whatever it is popular. You know, it's absolutely sold out. And how you harness that, because obviously these are long-term products, and therefore, but are people sort of going to go with the flow, and therefore Barclays is suddenly, you know, very popular, gets on Twitter, Facebook, and therefore people start investing, you know, their ISAs in Barclays.
I think it's a really interesting world we're in, you know, where there is very tight control on regulated advice. But you're absolutely right, Andrew. You know, most customers go out and do actually talk to somebody before they purchase. But as you say, it's family and friends, and increasingly, effectively unregulated advice in the public space. You know, through Twitter and through other social media, people can stand up and can push products and recommend products outside the regulatory framework. And I think that's kind of one of the really interesting challenges. Is it's difficult, you know, when customers walk in, you know, and start asking detailed questions. You know, if you're trying to stick within the rules of just delivering an execution-only service, when others can actually, you know, write whatever they like in the media, without regard to the regulation.
Yeah, I'd agree that change in consumer behaviour is one of the most, I guess, fundamental impacts outside of the RDR. So I always use the analogy of going to see a doctor. So 20 years ago, you'd gone to see a doctor for a professional opinion. Now what do people do? Well, they self-diagnose. They search on the internet, they ask friends and family, and actually what they go to is the doctor for that reassurance of second opinion. And that's a pretty fundamental impact, whether you're a financial advisor or a product provider, how you deal with that change in consumer behaviour.
And trust can be quite personal, can't it? If someone has had a long-standing relationship with a financial advisor, their perception of financial advice tends to be much higher than if they've not previously engaged, so that the view of an individual tends to be more positive than the view of the profession overall. So that's a real challenge. So let's throw it out to the audience then. I think there's a roving microphone that should be available there at the back and at the front. So any thoughts or perspectives that people would like to question the panel with? Yes, a gentleman there on the right, just over by the pillar. Perhaps if you could say your name and your organisation as well, please.
My name's Chris Clark. I work for an investment company called MSD Capital. I'd just like to ask Ed, he's mentioned that persistency is a key to profitability for fund managers, and persistency is a function of the relationship with the client, and that seems to be getting wider. What's Fidelity going to do about that?
Well, Fidelity obviously today runs a pretty diversified business. So, you know, the fact that we are already direct-to-consumer, financial advisor, we run a platform business, you know, that helps us manage that spread of you know, different types of customers and different dynamics of distribution. So, you know, one of the well-diversified businesses is you know, one of those aspects of helping to manage you know, differences in persistency and asset life. You know, like a lot of asset managers, another sort of major sort of development theme for us is, you know, increasing investment in our solutions offering. So over the last 2-3 years, it's been an area of major focus, because one of the things that we do find is whereas sort of traditional asset classes are absolutely exposed to those sort of persistency measures that I highlighted, those solution type products have completely different dynamics. And the challenge for any asset manager going into that space is it's a very, very different process from traditional asset management.
Thank you.
Just come on to that. But does that mean you're going to go directly to the consumer?
Well, today we have very clearly we have a direct-to-consumer proposition. Today, absolutely, it's non-advisory, and there's no plans to change that. So, you know, Fidelity does run obviously an execution-only business today.
Right, but that will be a focus of your attention going forward.
Yeah, absolutely. But there's also, you know, clearly there's opportunities for Fidelity in the advisory market as well. So, you know, through our funds network proposition, you know, we are seeing that business grow year on year as well. The interesting thing, I guess we're relatively fortunate at Fidelity, we're operating in a number of different growth markets, whether that's execution only, whether it's the platform market. You know, the workplace market for us has been, you know, fantastic over the last few years as well. So, you know, running that well-diversified business has proved dividends for us over the last few years.
Can I just pick up on that? Because there was a comment you made, Andrew, about, you know, one of the impacts of RDR would be that churning would plunge. And I just think, you know, given that we're likely to see the advent of a lot of lower cost unit classes, is that in the interest or not of customers going forward?
In terms of the...
If you're saying churning of
Yeah.
books is going to plunge, because surely isn't there a situation here where it may be in the interest of the customer to actually turn their investments over to...
It is. I suppose it depends on to what extent you think existing behaviour is driven by the advisor and the advisor churning because of the commission, as opposed to the customer doing it themselves. So I think in today's marketplace, because a lot of customers are not particularly active, they're dependent on the advisor, then they will only change their investments if the advisor tells them to. In the future, as people get more engaged, they become more direct, more execution only, then they will be more in control. But I think that's going to be 5 years out rather than today.
And maybe to add to that, I guess there's a change in dynamics now in terms of, I absolutely agree in terms of less churn between product providers. What we're already seeing, especially in the platform space today, is much longer term partnerships starting to be formed, and that's becoming pretty critical. So people are now making decisions around, I guess, product providers, platforms over a 3 to 5 year period. Whereas I think sort of go back 10 years ago, actually the mix of products would have been completely different. What we are seeing, especially in the advisory space, is through the adoption of things such as model portfolios, a much more institutional-like relationship in terms of the fund managers. So there actually we do see turnover increasing at the moment in the advisory space.
And just picking up the point about I mean, there's been a kind of a theme running through about the consumer taking more control and becoming more aware, and to an extent, I mean, I was struck by your comparison with the disintermediation in the personal lines market in general insurance of when Direct Line moved. And so if you were an advisory firm now, what would you be doing to prepare post RDR in terms, how would you outline your credentials? What do you think you need to be doing to kind of make sure that your customer base is retained and that actually you do attract those people who, many of whom will still need one contends face-to-face advice? Andrew?
So I think the starting point is obviously your existing bank of clients and things like that. And I think many advisory firms will probably find a good third, and it could even be half, of their existing clients they really can't economically deal with. And so I think they'll have to, have the decision, to essentially not service those, or do you, as Barclays seems to do, encourage them to do online execution, and then essentially triage when they do need advice, they come to you needing advice with the assets and things like that. So that's I think, first of all. Then I think secondly, on the people you still want to deal with, there's going to be more segmentation in terms of here are the people who really do have complex needs, lots of assets, and therefore you're going to have one proposition in terms of how you service them, versus people who have very occasional need, maybe a review of their portfolio, and therefore you're going to have to serve them differently. You might have to have different types of advisors, a different advisory process, and things like that. And potentially you might have to have different legal entities, because one may be more independent and the other is restricted, and you probably are going to have to set those up in a couple of different entities.
Okay.
Yeah, I'll go actually to add to that. So I think actually RDR presents such a great opportunity for financial advisors. It's those financial advisors who don't see RDR or just meeting the RDR is the only thing that they do. So the advisors that will struggle are the ones who say, actually, all I need to do is comply with advisor charging and qualifications and work out if I'm independent and restricted. We work with some great financial advisor businesses who actually are capitalising on the fact that actually they're already QCF level 4 or above qualified, they're already fee-based, and actually they're starting to capitalise on the market opportunities it's presenting to actually really become quite differentiated in the marketplace. Those guys are really focusing on their value proposition, understand the segments of the market in terms of who they are going to work with, who they're not going to work with, and are designing propositions for those segments. And those businesses are the ones that are going to succeed. And if anything, they're going to have hugely successful businesses post-RDR.
Yeah, I think a large element of it is about those advisors who can form a very strong relationship with the customer to clearly position themselves as being an agent for the customer and to move away from that product flogging strategy, which the industry has been cursed with for generations. So I think for those intermediaries, focus very, very clearly on, I'm here to help you achieve your goals, and that's my purpose here. and therefore I'm going to provide you with an ongoing service. I will be here for you in the future. I think those are the people who've got a sustainable model.
Okay, any more thoughts from the audience? Yes, second table in there.
Hi, it's Chloe Harmer from Accenture. Ian, it's a question for you. I'm just interested to hear a bit more about the execution-only proposition. From some of the clients I've been working with who focus on the mass market, a lot of the research that's been coming back has been saying that for a lot of those clients, if they have investments of about greater than £10,000, although they are willing to kind of consult with family and friends, they still find that even though it's a small amount of investment to them, it's a very significant amount, and they still need the reassurance of kind of consulting with a financial advisor. And also, not all of them are still confident with regulated products and using the internet for kind of the more complex ones. I'm just curious to kind of hear your experience in terms of those customers who come into the branch and you offer the execution-only proposition. What proportion do you think of business that you potentially lose because you can't service them face-to-face?
It's a very good question, and it's undoubtedly true that it's not a universally appealing proposition. There are indeed those segments of the population who would like advice. I'd go back to the point that was made. It isn't always fully regulated advice. There are a lot of questions that customers want to ask, which are very simple points of information and clarification. So it is simple questions like, I've already bought a cash ISA, can I have an investment ISA at the same time, in the same year? So it's simple things like that which can be answered without providing regulated advice. So yes, there is a segment of the population at the moment that we are not able to satisfy because we're not provided that regulated advice. Can't really go into it, don't particularly want to go into details of the split of the customer base, but suffice to say, we've launched the proposition just over a year ago, and we're continuing to attract new clients to it. So we believe that there is a segment of the population for whom that's the right solution. Clearly there are others that aren't, and we encourage those who want advice to go and visit unbiased.co.uk and find themselves an advisor. It's really important here. This isn't about driving all our old advice customers down an XO route. It isn't the right answer for all of them.
I guess there will be, in whether it's 2 or 3 years' time, there will have to be more discussions between the regulators and the market in terms of how you deal with exactly those customers you brought up. It's uneconomic for them to have full advice, but they need, not necessarily full advice, they need advice. So that's where streamlined advice has to fit in. You just have to sort out, what will work, get the regulators satisfied and the economics to work, because that's what's the gap currently.
Yeah, and I agree with you. And I think it's personally a great disappointment that the simplified advice regime has not come to fruition. Mm-hmm. I think a lot of people have looked at it. We've looked at it. We'd love to be able to do that. We'd love to help those customers. But at the moment, there isn't a regulatory framework. There isn't a consensus of view between the FSA and the FOS that makes delivering that simplified advice an attractive proposition. Passionately believe that there's a big cadre of the UK population that would like something more than execution only, but will not be able to afford full advice. And I think as an industry, we've got to find a way of satisfying them, mm-hmm. because I think we create a long-term problem for ourselves if those customers are not investing and for the long term are preparing for their retirement.
Thank you. Any more thoughts from the audience? Any further questions? One thing I was reflecting on in terms of, Ian, you talk about the winners might be those that are explicitly agents for the customer. So there's been a lot of debate about the prospect, about the sort of redefinition, if I can describe it that way, of independence. How does the panel, how do you all believe the role of independence will play out in the future? And will that be the brand and the differentiator that perhaps it's been to date?
I suppose there's independence as defined by the regulator, and there's independence in the mind of consumer. So I think in the consumer's mind, if you are unbiased and offer a reasonable range of both products and alternatives within those products, then even if you're technically called restricted, I think the consumer will be fine with that. So I think as from a consumer's point of view, then as long as you're unbiased, then I think that's satisfactory, even if you're not called independent.
Yeah, I guess the sort of at the moment, I think sort of still the independent restricted terms are probably unhelpful, and again that's an area potentially under sort of MiFID II that hopefully can become more clarified. The vast majority of financial advisors in the UK are going to end up in the restricted camp. Is going to be the outcome as it stands. So actually compliance with independence is going to be an increasingly more difficult thing. And that's a huge shame because actually there's an awful lot of advisors who do operate on a very independent basis, but due to how the regulations have been written, they're going to end up in restricted. There's a really unfortunate phrase that's now come out, which is whole of market restricted is the new term for... I guess it's an advisor who's independent in terms of mindset and how they operate, but from a regulatory point of view, they're actually restricted.
Yeah, and I think it's often a distinction which is lost on the customer. I think yours is the critical one. You know, I've lost track of the number of customers I've spoken to or focus groups I've sat in where a consumer has explained that they've got a great relationship with their IFA and then promptly described and revealed it to be a tied firm. You know, that they just don't understand the distinction between independent and restricted. The key thing is going to be, I think, for success in the future, is that alignment with the customer. Do they believe that their advisor is on their side?
So just on that point then, there's been quite a lot of reflection about the growth of wraps and platforms, and quite a detailed discussion about BIPs and the value chain and so on and so forth. So if you were a end customer, how would you describe the kind of benefits to an end customer of seeking advice through an advisor that's using a wrap or a platform?
Well, there's, and I guess this is an interesting sort of evolution around how platforms may change going forward. So if you look at the benefits a platform would give to the customer, there's also benefits they give to the advisor as well. And we expect over a period of time, actually, that distinction between what the services being provided to the advisor will be quite differently to the customer. There's a huge number of benefits platforms provide to customers today in terms of aggregation of assets, the ease of servicing, the clarification or the consistency and consolidation of reporting. Those are all huge benefits for consumers to understand their financial needs. Go back to the world before platforms, they would have been dealing with multiple product providers, and trying to get that single view of what's happening with their financial wealth would almost be impossible. Mm-hmm. But I do believe that over time what we'll start to see is those services that are absolutely purely targeted at the advisor will over time potentially be charged to the advisor versus those of the customer may be charged differently. And
you made some reference to that area as well, Andrew. And how well do you think the market is articulating these benefits in a kind of transparent and easy to understand way?
I think currently it's been easier to articulate to the advisor than the end consumer, partially because, as we said, the end consumer is often not particularly engaged and they're very dependent on the advisor, so that's one thing. I think even going forward, I think people will understand the benefits Ed said. Whether that will actually then get them to move assets that are off platform onto platform is another matter. Things like that. Again, if an advisor is involved, that probably might take place. But I think in terms of his direct consumer, I'm not sure there's sufficient benefits that people would go and move all their assets on there as opposed to their new assets.
I think it depends on the proposition you've got around it, because I think that having all your assets in one place can be a significant advantage. You said before, I remember a long time ago when I first got involved in platforms, a direct-to-consumer platform which we discovered as being intensively used by IFAs who'd uploaded all their customer portfolios on because they could get an evaluation at the click of a button rather than having to phone around from asset manager to asset manager. So I think there are some significant advantages for customers if they do put them all on the platform. And I think increasingly building a proposition that leverages that, I think, will be one way to persuade them to move on platform with assets. If you can provide a service that says, I can help you understand, or I can either help you understand or help yourself understand your position, it'll be better if they're all in one place, so let's get them all on one platform.
And ultimately, platforms are service propositions, so the thing that absolutely is going to differentiate them going forward is not going to be how many funds you've got or how many product wrappers. That's kind of becoming more and more of an irrelevance. It's all about delivering exceptional customer experience. And if you're able to do that, actually aggregation of assets is actually quite straightforward, because actually the customer or the advisor wants to do it, because there's huge benefits for them.
Mm-hmm. Thank you. Okay, there's a chance for one more question. Yes, lady at the front here.
Eliza Dungworth from Deloitte. We've had a number of clients come to see us recently where they believe they have very strong investment performance and are concerned that RDR has made all the focus on cost and expenses rather than outcomes. How valid are those concerns, would you say?
That's probably one reflection on my presentation, isn't it? So I guess it depends on what the asset manager's doing. So I firmly believe that, you know, an active fund manager delivering truly unconstrained, differentiated performance actually should have, less to worry about than a fund manager who is delivering index plus performance. It is going to be in those more commoditized marketplaces where if I was an asset manager, I would have concerns. Those products are really going to be dependent on their ability to drive scale in those product lines. So, if you've got a fund manager coming and saying, I'm absolutely fantastic at delivering, above average performance, then actually that business model is probably more sustainable than one who is, potentially, struggling to hit the benchmark.
Any more? There was a gentleman just at the back there, just last. Yep.
Kerry Chapman from TCS. For these international businesses like Barclays, do you think that the lessons of RDR will be transitioned across your other business units?
I think that's a good question. In fact, Steve should probably answer this, given your your CII role. I think it's interesting actually. Increasingly, there's kind of regulatory transfer amongst different jurisdictions. So I think across the piece, I think we're all looking to learn. It's an increasingly global world, and we get judged by the same standards wherever we trade. So I think it will inform business models and potentially regulatory regimes in the future. But Steve?
Yeah, I'll just say a couple of words. I mean, the CII is actually involved in some overseas territories, notably India and some territories in the Middle East. If you take India, for example, all the kind of experience that we've seen in the UK, which is relatively towards the forefront of change, commissions disclosure, improvement in early product surrender terms, introduction of training and competence, and clarity of status for different types of advisors is starting to emerge in the emerging markets, much in the same way over recent years as it's done here. And that includes kind of mandatory qualifications for anyone that wants to offer financial advice. So I think all the trauma that we seem to be going through here is something that is not specific.
The issues that the RDR is trying to address are not specific to the UK. So if you look across the Australian market are going through a similar process. India, I was out in India last year talking about the RDR. They're fascinated in terms of how they might adopt some of the standards. You look across Europe as well. And the Dutch are incredibly interested in implementing similar standards to the RDR. And actually elements of what the RDR is doing will come out as part of MiFID II. So absolutely, global regulation is all going in the same direction as the UK.
I think it's an interesting issue there for a global organisation. Do they make the changes in RDR here and therefore globalize it, even though they might be slightly ahead of the game, or do they just make the changes in the UK, continue the old model overseas, maybe make a little bit more money, but then have to go through that second transition? I think that's a real challenge for people, how quickly they do sort of globalize the UK model, as it were.
Absolutely, and I think that the thing to reflect on is the time it's taken this market to go through change won't be the time it takes emerging markets to go through change. The change process in emerging markets will be much, much more rapid, and that's perhaps food for thought for the relative competitiveness of the UK going forward. So, thank you very much. I'm pleased to see. Thank you. Can I just ask you to show your appreciation for the panel now? And I'm delighted that via City Airport, Barry has now joined us on what will be you must be got up very, very early for this opportunity today. So thank you very much, panel, and I'll ask Barry to join us now. Thank you.